Hello friends, we begin the most interesting section of this series on how three financial statements are linked with each other. And I think it is very important to understand this if you want to get the full picture of company's financial performance. And it is the first step to understand financial modeling, because at its core, financial modeling is linking financial statements with each other and projecting them into the future. So we begin with our lemonade stand at day 0. And I included day 0 because I wanted to show you how the company is financed before it begins its operations. And there is no such thing as day 0 in real life. So we had paid-in capital of $1,000, we had bank loan of $500, and as you can see, we have all our statements here. And we have beginning cash balance of $0. And as you can see in the income statement, we don't have anything yet because we haven't started our operations. In the cash flow statement, we see that we have $1,000 of inflows from equity injection, and then we show on the balance sheet that we have paid-in capital of $1,000. And we show loans received of $500, and we show on the balance sheet short-term portion of this loan of $250. If you remember, short-term portion are payments for the principal amount of this loan over the next 12 months. So we have a 2-year loan, so during the first year we will pay $250, which is our short-term portion. So our long-term portion are any principal payments after the first year. So in our case, we have $250 of payments during the second year, which is our long-term portion. And we have current liabilities of $250, we have total liabilities of $500, and we have total equity of $1,000. So our total liabilities and equity is $1,500. As you can see in the cash flow statement, we don't have any operating cash flows and investing cash flows yet, so our total cash flow is $1,500. So beginning cash balance of $0 plus total cash flow of $1,500, we have ending cash balance of $1,500. So on the balance sheet we have cash of $1,500, we don't have any receivables, inventories or fixed assets, so our total assets are $1,500. So as you can see, we have total assets of $1,500 and total liabilities and equity of $1,500. We have a balanced balance sheet. Now let's make it more interesting and move to day 1. During the first day, we purchased a lemonade stand for $800, we purchased equipment for $200, and we purchased raw materials. We bought $50 at the wholesale store, and we purchased cups for $50 on credit from our local supplier. As you can see, we have balance sheet, income statement and cash flow statement. And in the income statement, we again don't have anything because we haven't started our operations yet. And in the cash flow statement, we can see that our beginning cash balance is $0. So if you remember, balance sheet is a photo of our company at a specific point in time. So in our case, we have a photo at the beginning of a financial period and another photo or balance sheet at the end of the financial period. And profit and loss and the cash flow statements will show us what happened between these two pictures. In other words, for you to understand the logic, we have a beginning balance, we have an ending balance, and for us to understand the change, there was something that increased the balance during the period and something that decreased the balance during the period. Let's have a look at an example to have a better idea. For example, we have retained earnings at the beginning of the period. So what increases our retained earnings? It is our net profit during the period. And what decreases our retained earnings are dividends. So retained earnings plus net profit minus dividends will yield us retained earnings at the end of the period. In our case, we are comparing two pictures. The first picture is where we had nothing, our company is not in existence yet, and another photo is a balance sheet at the end of day 1. So we need to show how we got from having nothing to a balance sheet at the end of day 1. In our case, for retained earnings, we had a beginning balance of $0, plus we have a net profit of $0 during day 1. We didn't pay any dividends, so our retained earnings at the end of the period is again $0. And we can reflect this on our balance sheet. Now let's have a look at paid-in capital. We have again $0 of paid-in capital at the beginning of the period, plus we made a capital injection of $1,000, minus paid-in capital distribution, so our paid-in capital at the end of the period is $1,000. So on the cash flow statement we reflect equity injection of $1,000, and on the balance sheet we can show that we had a paid-in capital of $1,000 at the end of day 1. Again with debt, at the beginning of the period we had no debt, plus new debt of $500, minus debt repayments during the period. We haven't repaid any debt during day 1 because we have weekly repayments. And our ending debt balance is $500. So 0 plus 500 minus $0, we have $500 of loans. So we reflect loans received on the cash flow statement of $500, and on the balance sheet, again, as you remember, during the first 365 days or 12 months, we had $250 of principal repayments for the next year. And the repayments after 1 year is the remaining $250. So we have $250 of short-term debt and $250 of long-term debt. Now let's have a look at property, plant and equipment, our fixed assets. So at the beginning of the period we had $0 of fixed assets, and this balance is increased by capital expenditures of $1,000, which is our lemonade stand and equipment, and minus asset disposal. So we didn't sell any of our assets during day 1, so it's $0. So our fixed assets at the end of the period are $1,000. So we reflect on the cash flow statement that we have an outflow of $1,000 to purchase our fixed assets. So our investing cash flow is $1,000. And on the balance sheet we can show that our fixed assets at the end of day 1 are $1,000. Now let's have a look at our inventories. At the beginning of the period we had $0 of inventories. During the period we purchased $100 worth of inventories, which are ingredients for $50, and plastic cups for $50 from our local supplier. And we have not used any of our inventories, so it's $0. So we have ending inventory balance of $100. So as you can see, we show all $100 as a change in inventories, even though we spent only $50 for the ingredients, and the other $50 is not an actual cash movement. Actual cash movement is reflected in the overall change in working capital, and you will see in a moment. So after we are done with payables. As you can see, with payables we had $0 at the beginning of the period, plus additional payables of $50, which are our cups from local supplier, and minus payables repaid during the period. So at the end of the period we have payables of $50. So again, we show change of $50 on the cash flow statement, and we show that our balance of payables at the end of day 1 are $50. Same as with inventories, even though we didn't actually receive $50 of cash from our suppliers, we received $50 of inventory equivalent during the period, and the net change in working capital during the period is minus $50, which reflects actual cash we spent during the period. So we took $50 and we spent them on lemons and oranges. So we have operating cash flow of minus $50, we have investing cash flow of minus $1,000, and financing cash flow of $1,500. And when we add this all together, we have a total cash flow of $450. So at the beginning of the period we had $0 plus total cash flow of $450. We have ending cash balance of $450. So we reflect this on the balance sheet. Now we have total current assets of $550 plus fixed assets of $1,000. Our total assets are $1,550. And our total liabilities are $300 of current liabilities plus long-term debt of $250. We have total liabilities of $550. Plus our paid-in capital, we have total liabilities and equity of $1,550. Now let's have a look at week 1. So during the first week, we sold 90 cups for $3 each. We sold 20 of those cups on credit to friends. And our costs were 50 cents for ingredients and 50 cents of plastic cup for each cup. And we had $15 of salary expenses every day. And we have a 2-year useful life of our fixed assets. For our OPEX, we had Instagram expenses of $5 per day. And we had finance and income tax expenses. As you can see, on the balance sheet, we show at the end of day 1, we have cash flow statement and income statement. So again, at the beginning of week 1, we had no business, so we had no cash, nothing. And we will show on the cash flow statement and income statement what happened during the week to explain how we got to the end of day 7 balance sheet. Let's start with the income statement. We sold 90 cups for $3 each, so we had $270 of sales. And we had 90 cups, and cost is $1 per cup, which is 50 cents for the ingredients and 50 cents for the plastic cup, so $1 per cup. And $90 times $1 is $90 for the raw materials. Then we had salary expenses of $15 per day, times 7 days is $105 for the salary. And for the amortization expense, we have $1,000 of fixed assets, and we have a 2-year useful life. So $1,000 divided by 2 years and by 52 weeks, we get amortization expense of $10 per week. So 90 plus 105 plus $10 is $205 is our cost of goods sold for week 1. So 270 minus $205, we have a gross margin of $65 during the first week. So cost of goods sold are all expenses related to making the product. So these are salary expenses of the people who are making the product, and these are all the raw materials included in the product itself. And operating expenses are all expenses not directly related to making the product. So this may be the salary expenses of office employees, this may be marketing expenses, utility expenses, insurance expenses, and the research and development expenses. So in our case, for our lemonade stand, we only have marketing expenses for our Instagram ads, which are $5 per day for 7 days. And this equals to $35. So when we subtract operating expenses from our gross margin, we get a $30 of operating income. Then we have finance expenses. We have a $500 loan at 20% interest, annual interest rate. So to get our weekly interest rate, we divide our annual interest rate by 52 weeks, and we get our weekly interest rate. So we multiply our loan by weekly interest rate, and we get $2 of interest expenses. So our finance expenses are $2. So $30 minus $2 is $28. That is our profit before tax. We have a 20% profit tax, so 20% of $28 is $6. So we have $6 of income tax. So our net profit is $28 minus $6 of income tax. We have a $22 of net profit during the period. Now net profit goes directly to net income at the beginning of our cash flow statement and to our retained earnings on the balance sheet. So during the first week, we had a $22 of net profit, and this directly increases our retained earnings during the period. And we see that net income is the beginning of our cash flow statement. Now, what do we know on our cash flow statement? We know that we had an equity injection of $1,000 during the first week, so our paid-in capital is $1,000 at the end of day 7. We paid $2 of loan interest during the first week. And for our debt balance, At the beginning of the period, we had no debt, $0. So we had new debt of $500 that increased our debt balance. And during the period, we repaid $5 of our debt. So we have a 2-year loan. So $500 divided by 2 years and divided by 52 weeks equals to $5 of repayments each week. So we have 0 plus 500 minus $5. We have a end of period debt of $495 at the end of day 7. So as you can see in the cash flow statement, our net amount that we received from our loans is $495, which is we received $500, repaid $5, so our net amount here is $495. And for the balance sheet, again, we need to split our debt into short-term and long-term. So during the first year, again, from end of day 7, in the next 365 days, we still repay $250. And the remaining amount of $245 will be repaid after 1 year. So we have $250 as short-term debt at the end of day 7, and we have long-term debt of $245. So we have financing cash flow of $1,493. Now let's have a look at our fixed assets. At the beginning of the period, we had $0 of fixed assets, and our balance increases by capital expenditures. We spent $1,000 on our stand and on our mixer. So we show in the cash flow statement $1,000 were spent on the fixed assets, and we have investing cash flow of $1,000. We haven't sold any of our assets, so we have $0 of asset disposal. But during the period, our equipment got older and our stand got older, so we have an amortization expense of $10, which we calculated in the income statement. So our ending fixed assets balance is $990. So on the cash flow statement, we add to net income depreciation of $10 and interest expenses of $2. And now we need to calculate change in working capital. So at the beginning of the period, we had $0 of receivables, and we had $60 worth of cups sold on credit to our fans. So we sold 20 cups times $3 per cup. $60 of cups were sold on credit during week 1. And we had $0 of repayments from our friends. So our receivables at the end of the period are $60. So as you can see, we have a change of receivables minus $60. And we show on the balance sheet that our accounts receivables balance at the end of day 7 is $60. Let's have a look at inventories. We had $0 at the beginning of the period, plus inventory purchase of $100, minus inventory used of $90. These are 90 cups, so we had $1 per cup, so we used $90 worth of inventories during week 1. So our ending inventory balance is $10. So we purchased 100 worth of inventories, but we only show $90 on our income statement. So we didn't account for this $10 worth of inventories purchased during week 1. So we need to show that we have an outflow of minus $10. And our ending inventory balance is $10. So for our payables, nothing changed. We had $0 at the beginning. We had $50 purchased during the period from our suppliers, and we had $0 of repayments of our payables during week 1. So our ending payables balance is $50. So we show again change of $50 for payables, and on the balance sheet we show ending balance of payables of $50 at the end of day 7. So minus 60 receivables minus 10 inventories is minus 70, plus payables of 50, we have a net change in working capital of minus $20. So we have operating cash flow of $14 during week 1. We have a relatively simple business, so we can actually follow all the cash transactions, operating cash transactions that happened during the period. Let's have a look. We sold 70 cups worth $3 each for $210. These were cash sales during the period. We purchased $50 worth of lemons during the period. We paid salary expenses of $105. We spent $35 on Instagram ads, and we paid $6 of income tax. So $210 we received, and we paid $50, $105, $35, and $6. So our net operating cash flow during the period is $14. So you can see how we got to the $14 of operating cash flow. So now we have a total cash flow of $507. This is operating cash flow plus investing plus financing cash flow. So our beginning cash balance was $0 at the beginning of the period. So $0 plus $507, we have a $507 at the end of the period. So we see on the balance sheet we have $507 of cash. So our current assets are $577 and our total assets are $1,567. We have current liabilities of $300. We have total liabilities of $545 and total equity of $1,022. We add equity and liabilities together and we get total liabilities and equity of $1,567, which is exactly equal to total assets. Let's make it more difficult and have a look at week 2. During the second week, we sold 95 cups. Some of them again were to friends on credit. We had costs, but in this week we also had $5 worth of lemons that were expired during the week and we had to throw them out. We again had operating expenses only for the Instagram ads, and during the week we distributed $20 in dividends, and during the week 15 friends from week 1 repaid to us. We purchased more lemons for $70 and we repaid all our payables and purchased again $70 of cups on credit from our suppliers. So what do we see here? We have a balance sheet, income statement and cash flow statement for week 1. So for balance sheet we have a picture at the end of day 7 and we want to see our balance sheet at the end of day 14, at the end of the second week. And with the income statement and cash flow statement we will show how we got to the balance sheet at the end of day 14. So what do we know? We know that our beginning cash balance is $507 at the beginning of week 2. So cash at the end of week 1 is the beginning cash at the beginning of week 2. So this makes sense. So let's again build our income statement. We have 95 cups at $3 each. We have $285 of revenue during week 2. Then for cost of goods sold, again we have $1 cost of goods sold of each cup for raw materials. So 95 cups times $1 plus $5 of expired lemons. We have $100 of cost of goods sold for raw materials. Then we had $15 of salaries times 7 days. We have $105 of salary expenses. And again amortization of $10 during week 2. So $100 plus $105 plus $10, we have $215 of cost of goods sold during week 2. So 285 minus 215, we have gross margin of $70 for week 2. For operating expenses, again we have $35 of Instagram ads, and 70 minus 35, we have operating income of $35. Now to calculate our interest expense, we have a base amount of loan not $500 but $495. So we calculate our interest based on $495 loan amount. So $495 multiplied by weekly interest rate still yields us $2 of interest expense. So $35 minus $2 of interest expenses, we get profit before tax of $33. And our income tax is 20%, so 20% of $33 is $7 of income tax during week 2. So our net profit is $26 for the second week. And again, our net profit goes directly to net income on the cash flow statement and to the retained earnings on the balance sheet. But what is retained earnings? Retained earnings is increasing by the net profit and is decreasing by dividends paid. So we had $22 at the beginning of the period, plus $26 of net profit and minus dividends of $20 during the period. We have retained earnings of $28 at the end of week 2. Our paid-in capital remains unchanged at $1,000. Now let's have a look at the accounts receivables balance. At the beginning of week 2 we had $60 of accounts receivables plus 20 cups we sold on credit multiplied by $3 each, $60 of cups on credit, and we received $45 from our 15 friends. So 15 cups times $3, we received $45 from our friends from week 1. And we have a accounts receivable balance at the end of week 2 of $75. So $60 beginning balance plus $60 of sales on credit to our friends in week 2 and minus $45 of accounts receivables repaid. So we have $75 at the end of week 2. So similar to week 1, in the income statement, we assume that we sold all 95 cups, but 20 of them we didn't actually receive any cash. So in the cash flow statement, this we reflect as minus $60 as cash we didn't receive. And plus $45 is the cash we received from the creditors from the first week, our friends from first week. So minus 60 plus 45 is minus 15. This is what we reflect in the cash flow statement. And on the balance sheet, we show our receivable balance of $75. And as you can see, our change of receivables of minus $15 is the change of accounts receivable balance from week 2 and week 1. $75 minus $60. But you need to be very careful because the change on the balance sheet is not always equal to the change in the cash flow statement. Because there can be forex adjustments, maybe some friends didn't actually repay to us anything and we decided to write off those receivables. So you can see the difference on the balance sheet and on the cash flow statement, but it is not always the same. So be careful. And now with the inventories. At the beginning of week 1 we had $10 of inventories. We purchased $140 worth of inventories, so $70 lemons and $70 of cups purchased on credit, and minus $95 of inventory used for our lemonade cups, and minus $5 of inventory that became obsolete. So the lemons got expired and we need to write them off. So our inventory at the end of the period is $50. So 10 plus 140 minus 95 minus 5, our ending inventory balance is $50. So we show a change in inventory of $40. So we spent $140 on the inventories, but in the income statement we only accounted for $100 worth of inventories. So here we need to account for the $40 that were not accounted for in the income statement. So again, we can see that inventory change between end of day 7 and end of day 14 on the balance sheet. We can see that it is $40, and it is the same as in the cash flow statement of minus $40. But again, you need to be very careful that in the real life with large and complex businesses, the inventory change on the balance sheet is not always equal to the change on the cash flow statement, because there can be FX adjustments, there can be inventory write-offs that are not reflected in the cash flow statement. So be careful, but you can see that there is some correlation between these two. So now let's have a look at the accounts payables. At the beginning of the period we had accounts payables of $50. Plus we purchased $70 of cups on credit for week 2, and we repaid $50 during the second week for the cups we purchased in week 1. So our ending accounts payables balance is $70. So 50 plus 70 minus 50 is $70 of accounts payables at the end of week 2. So we increased by $70 the cups and decreased by 50. So we have a change in payables of $20 that we reflect in the cash flow statement. And on the balance sheet, again, we show accounts payables of $70 at the end of week 2. Again, you can see that the change on the balance sheet of 70 and 50 is also 20, as we show in the cash flow statement. And again, you need to be careful because this change is not always equal to the change in the cash flow statement. Because, for example, maybe our supplier provided to us like bad cups and we decided not to pay to our supplier, and our payables would be written off, but on the cash flow statement there wouldn't be any change reflected. So be careful with this. So we reflect in the cash flow statement, we add depreciation to net income, we add interest expense, and our change in working capital is minus $35. So our total operating cash flow is $3. And again, similar to week 1, let's have a look at the cash transactions during the week to show you how we got to $3. So during the week, we sold 75 cups for cash. Times $3, it's $225. Our friends repaid to us, 15 friends repaid at $3 each, so we received $45. And we purchased lemons for $70. And we repaid to our suppliers, we repaid $50. And now we have salary expenses of $105, Instagram ads of $35, and we paid income tax of $7. So we received $225 and $45, and we repaid $70, $50, $105, $35, and $7. And the total operating cash flows during the period are $3, similar to what we got in our cash flow statement. So we adjusted our net income for all the non-cash transactions and also got to $3 of operating cash flows. Now our fixed assets beginning balance is $990. We had no capital expenditures, we didn't sell any of our assets, so our amortization of fixed assets is $10, and our fixed assets at the end of the period is $980. So essentially we just decrease our balance by amortization. So in the cash flow statement we didn't have any cash transactions, and on the balance sheet we have fixed assets of $980. Similar with debt, so we didn't have any new debt during the period, and we made a principal repayment of $5. So our debt balance decreased by $5, and we have ending debt balance of $490. And we need to split this balance into short-term and long-term part. Short-term part remains the same, so 1 year from the end of week 2, we still need to repay $250, and after 1 year, it is the remaining $240. So we show short-term debt of $250, long-term debt of $240, and now our total financing cash flow is minus $27, and our total cash flow is $3 of operating cash flow minus $27 of financing cash flow. So total cash flow is minus $24. So beginning cash balance of $507 minus $24 of total cash flow, we have ending cash balance of $483. So we reflect this on our balance sheet, that at the end of week 2 we have $483 of cash. So our current assets are $608 and our total assets are $1,588. And on the liabilities and equity side, we have current liabilities of $320, we have total liabilities of $560, we have total equity of $1,028, and our total liabilities and equity are $1,588, which is exactly the same as total assets. Now for you to really make progress, I will ask you to take a blank piece of paper and line by line try to recreate each financial statement without even looking at our answers. And then try to recreate what we've done during this video. In the next videos we will look at financial statements of public companies, and I will show you how I make initial screening of these financial statements to decide if it is a potential client for us or not.